If we see a U-turn inflation and inflation starts to rise next month or the month after that, what is that going to mean for the Federal Reserve Bank? And what's that going to mean for the fight on inflation, and how will that impact the economy? I'm going to get to all of that. The second thing that I want to touch on when it comes to inflation has to do with oil. And the reason I want to talk about oil is because, well, oil prices have come down very significantly off of their peak. If you remember when the pandemic hit in 2020, we had this huge drop in oil demand. Factories were shut down, planes were not flying, people were not driving cars. So the demand for oil and energy just sank. And now, again, let's go back to supply and demand. We have the supply of oil, but now no demand. And we saw the price of oil and gas plummet. Now what we have been seeing happen, well, let's go back to there. After that shift, we then started to cut the supply of oil because there was no need for it. And then you saw the reverse happen. The supply of oil got cut. Now you have not that much oil. And then the demand for oil started to shoot back up. People started traveling again. People started going out again. People started driving again, started going back to work again. Manufacturing plants started to open again. Now the demand for oil starts to rise while the supply of oil is down here. And that was when we saw the expensive gas all around the country because we had low supply but high demand. Then that started to regulate and things kind of calmed down in the oil market. But then, now we'll get to where we are now. In April of 2023, we saw this sudden shift because the OPEC countries came out and said that they wanted to cut the production, aka supply of oil. It was a surprise to the market. It was a surprise meeting, which meant that now all of a sudden, we have this demand for oil and the supply went boom down here. And the reason why this is significant, because then you are starting to see gas prices starting to rise again as we're starting to see oil prices rise. And it's unclear how much higher oil prices will go. But if you look at what the economists and experts say, they have, they always have their emotional views. But it looks like oil prices, at least for the near term, are going to be rising. And the reason why that's significant, and we tie this all together now, is because when oil prices and gas prices rise, yeah, that affects your cost to go to work, but that also affects the price of things that you buy. Because when you go to the store, you go to Walmart and you want to buy watermelons, it costs money to take that watermelon from the farm, take it to the warehouse, and take it to Walmart. A truck has got to put gas in their truck to ship that watermelon from one place to the other. So when the cost of distributing products goes up, the cost of the actual retail price of the product also has to go up because the cost for businesses rise. So when you see the price of oil rise, the reason why that's so significant is because it has such a strong trickle-down effect into so many different aspects of the economy. And this is where now understanding inflation, where we are right now, and where inflation could go is so important to understand, because right now we are seeing inflation fall. Good news. Although we're also seeing the economy get hurt and we have these predictions about where the economy is going. But inflation is falling, which is good news, especially when it comes to the Federal Reserve Bank's fight on inflation. The concern is if things like the housing market and if things like in the oil market to continue to progress the way that they are right now, that could push inflation higher. And this is where the Federal Reserve Bank, who is our central bank here in the United States, who has the decision-making power to decide what are they going to do with interest rates, because higher interest rates are one of the biggest tools that the Federal Reserve Bank has to bring inflation down. They're going to have to now kind of predict and make an estimate on what they want to do to bring this inflation down. If they decide to pause, hypothetically, and they say, we don't want to raise interest rates, and then inflation goes higher, that would make the inflation fight even more difficult because now you have to work even harder to bring higher inflation down. If the Federal Reserve Bank gets even more aggressive and they say, you know what, we see these red flags in the inflation sector or in the inflation area, and we want to get more aggressive, that's going to cause more pain in the economy. This is where the Federal Reserve Bank is going to be working to figure out what they want to do. And unfortunately, there's costs to higher interest rates and there's costs to lower interest rates. And yeah, it would be better if we avoided the inflation altogether. But the reality is this is where we are right now when you need to understand these different factors. Now, the reason why higher interest rates are one of the Fed's biggest tools to bring inflation down, they actually have two big tools. One is quantitative tightening and the other is interest rates rising. But let me start by interest rates rising because I think that's the more pressing and more discussed thing that the Federal Reserve Bank does. The Federal Reserve Bank has the ability to raise or cut interest rates. And the interest rates that they raise or cut are not mortgage rates, they are the federal funds rate. The federal funds rate is the interest rate that the Federal Reserve Bank or that banks charge each other when they lend each other money overnight. So you can think of it like the wholesale price the banks have to pay to borrow money. That is what the Federal Reserve Bank can set. And the Federal Reserve Bank, in order to cool down this high inflation, they want to cool down demand. Because let's go back to supply and demand. When you have more buyers than sellers for anything, whether it's a house, whether it's a car, whether it's avocados, when you have more buyers than sellers, that pushes the price of something up. So now when the Federal Reserve Bank wants to cool down how fast the price of things are rising, they don't want to see the price of things fall. Remember, they're looking for disinflation. They're not looking for deflation. They want to see the price of things rise by around 2%. That does not mean that we're going to go back to pre-pandemic level prices. That means that they want to see the price of things continue to grow, but less quickly than they're growing right now. But in order for things to grow less quickly, they need less people buying things. How do you get people to buy less things? You got to make things more expensive. Now, the Federal Reserve Bank can't go to Best Buy or Whole Foods and say, hey, raise the prices of your stuff. Instead, what they do is they raise the interest rates that banks have to pay. And when banks have to raise interest rates for you, people are less likely to borrow money. I mean, you could think about it like when you go to Macy's to buy a sweater. If that sweater costs $4, you're more likely to buy it than if the sweater costs $400. Because when something's more expensive, less people are likely to buy it. So when it comes to interest rates, it's kind of the same thing. When the Fed raises interest rates and the interest rate on your mortgage goes up or the interest rate on your credit card debt goes up, less people are likely to spend. Less people are likely to go out and buy. If less people are going out and buying a home because mortgage rates are higher, that means you have less buyers. If you have less buyers out there, that means you have less bidding wars. If you have less bidding wars, then sellers are not going to be able to increase the prices of their homes as fast because when you have 25 people outbidding each other to buy your $400,000 home, your home might sell for $485,000. But when you only have two people trying to bid each other to buy the home, it might only sell for $405,000. So when you have less demand, less buyers, less consumption, the price of things rise less significantly. And this is where the Federal Reserve Bank is trying to operate right now to cool down inflation by raising interest rates. And this is where there's a lot of argument, opinions, debate on what the Federal Reserve Bank should do and how they should do it when it comes to raising interest rates, because it's pretty clear. It doesn't matter who you ask or what type of person you ask. I think everybody agrees that the inflation that we have right now is still way too high. The part where people disagree is how do you bring it down? The Federal Reserve Bank is the main entity here that can help cool down inflation, and the tools that they have is number one, by raising interest rates. And the other side is people saying, you just got to take care of itself. Don't worry about inflation. It will take care of itself. Well, the problem is if you don't take care of itself, if you don't let it do that, and inflation continues to get worse, then that's going to make a much bigger problem, because inflation has a much bigger side effects than, say, a slowing economy, because inflation could cause a currency crisis. It could cause people not valuing the dollar that much anymore. It could cause people to worry about things like hyperinflation. That's a much bigger problem than a recession. We know how to deal with a recession. We've been through that. We go through a recession almost every decade. That's kind of something that we're very used to. It's a part of our economic system. Inflation crises are some things that we are not used to, and those have much more significant impacts, and that could cause much more broad pain, which is why fixing the inflation sooner rather than later is so important. Now, the second tool that the Federal Reserve Bank has to fix or cool down the inflation is through something called quantitative tightening. This one's a little bit more complex to understand, and I think it'll help if you understand quantitative easing first, because quantitative easing is when the Federal Reserve Bank is essentially increasing the amount of money out there. And there's a few ways that the Federal Reserve Bank can do that. Like the Federal Reserve Bank doesn't just put $1,000 in your bank account. Even when the stimulus checks were going out, that wasn't the Fed sending you checks. That was the government sending you checks. Now, the government doesn't have the money to send out $1,000 checks to people, which is where they then worked with the Federal Reserve Bank. So let's go to the government first, because it'll all tie in together. The government has one source of income. That one source of income is you, me, taxpayers, through tax dollars. That's it. Now, the government, for a long time now, has been spending way more money than what they bring in through tax dollars. This is called the national deficit. And we've been seeing a multi-trillion-dollar national deficit for a long time now, which means that the government generates tax dollars and then they spend these tax dollars and more through the help of debt. Now, where did they get this debt? Well, they can get this debt from you and me when we loan money to the government through something like a treasury bond or a treasury note. When you do that, you loan money to the government, they pay us back interest. And so now, when the government wants to send out, let's just say $1,000 check, they don't have the money to do that. So what do they do? Well, then they can issue more treasury loans that people can make. But there's not enough money or people that are going to be loaning money to the government to fund all of these checks, which is where the government will then work with the Federal Reserve Bank. So let's just say the government issues $1 trillion worth of treasury loans, and they call up the Fed and they say, hey, we want to do this thing. We want to send out stimulus checks, or we want to do this program. We want to build bridges. We want to do whatever we want to do. The government wants to spend money on something, but they don't have the money to do so. They can then call the Federal Reserve Bank, who has the ability to print that $1 trillion or whatever it might be, and then they loan that money to the government. The way they do that is by buying these bonds. And so they print the money, buy the bonds, aka loan the money to the government. The government has the money, and then they can do whatever they want, whether it's send out stimulus checks, whether it's build bridges, whether it's hire more military people. The government can do whatever they want. Now, this is all good until it's not good. Because if the government could spend an unlimited amount of money, the question is, why do we have to pay taxes in the first place? I mean, if the government can work with the Fed to print an unlimited amount of money, why do we have to go to work to pay taxes? And this is where the reason why is because there is a cost to the government spending too much money. And by spending too much money, I mean the Fed having to print money to subsidize the government. And that cost is inflation. Because inflation comes from the word inflate, which is when you increase the monetary supply. So when you increase the monetary supply, the value of each individual dollar goes down, in effect causing the price of things to go up because the currency that you're using to buy that thing has less buying power. That's what inflation is. And so over the last number of years, especially post-pandemic, the Federal Reserve Bank has grown their balance sheet, aka grown the amount of money that they've printed very significantly. And the things that they bought include treasury bonds, loans to the government, and they also buy mortgage-backed securities. And so mortgage-backed securities are essentially loans to fund the mortgage market because it's a way to help provide security and liquidity to banks, because now when a bank issues a mortgage, if a bank issues a $500,000 mortgage to you, a 30-year fixed-rate mortgage, if the bank had to hold on to that $500,000 mortgage, they're not going to get that money back for 30 years, which means that if somebody else comes to them for a loan, they might not have the money because all their money is already lent out. So this is where banks want to be able to liquidate and get out of these loans, aka sell these loans. That way they can continue making more loans. And so who can buy these loans? Well, regular people can buy these loans, but then also you have the Federal Reserve Bank that can continue buying these loans to encourage the mortgage market, to encourage people to lend and borrow. So the Federal Reserve Bank has been a huge buyer of mortgage-backed securities and treasury bonds. And during the pandemic, they also bought corporate bond funds, but let's just ignore that for now. So the big things that the Federal Reserve Bank has been buying are treasury bonds and mortgage-backed securities, which is how they built up this big balance sheet. And that was quantitative easing. Now, the second thing that the Federal Reserve Bank can do is quantitative tightening. Quantitative tightening is doing the opposite of the quantitative easing. Quantitative easing was buying up these treasury bonds and mortgage-backed securities. Quantitative tightening is selling these treasury bonds and mortgage-backed securities. Now, the reason why this is significant is because it helps relieve part of the Federal Reserve Bank's balance, because now they've printed this money and now they're trying to get rid of those assets by having private buyers go out and then buy some of these bonds off of the Federal Reserve Bank. The downfall is, well, when you have a big seller of anything, let's just say you have everybody trying to sell their home. Well, then that would push home prices lower because now you're increasing supply. And that's kind of what you see happen here. And the Federal Reserve Bank is doing this slowly for this very reason, because now when the Federal Reserve Bank has to sell off their treasury bonds, that means you're increasing the supply of treasury bonds. When you increase the supply of treasury bonds, that pulls treasury bond prices lower. And remember, a treasury bond is a loan to the government. The way that you get paid back is through interest. And the interest rate on these treasury bonds are inversely correlated to the price of the bond. I know this is very confusing. Just stick with me for another 60 seconds and it all makes sense. So if the Federal Reserve Bank is now selling off these treasury bonds, and then you see the price of these treasury bonds go down, that means the yields or the interest rates on these bonds go up. And who pays these bonds? The government. So that means that if the Federal Reserve Bank is working to sell off their bonds, interest rates go up, which means that the government's interest payments would also rise. Now, this is where it all starts to tie together with inflation, because now when the government has high interest payments that they need to make, that can be difficult because how do they make these interest payments? Through tax dollars. Where do they then generate these tax dollars? Through people like you and through people like me. So the government is working to generate tax dollars, and now what we're seeing happen is a bigger and bigger piece of the government's expenses is just interest. They're working now to generate tax dollars, not to invest in more infrastructure, not to give back to the community, but just to pay back their previous expenses. Right now, the estimation is that by in the next few years, forgot the exact year, but it was like the next few years, the government interest expense is going to exceed the total military budget. Why? Because not only is our national debt rising, but the interest rates on this debt that the government has to pay, because it's not a 30-year fixed rate mortgage, it readjusts. The interest rate that the government will have to pay on these debts is also rising. So we're seeing the government's costs rise, and the way that they pay for these costs is through taxpayers. Now, this is where we can start to see why the economy becomes so important, the second part of this video, because now when you have a growing economy, you have people making more money, businesses making more money, which generates to higher tax dollars for the government. But we're seeing different things happen in the economy. Like the Federal Reserve Bank said that they're predicting now a recession in the end of 2023. Now, I know for the average American, they're already in a recession, but it's expected to get worse. And this is where now, if people's incomes go down, or if people lose their jobs, or if business profits go down, that would also equate to less tax dollars for the government. And you can start to see why that's so significant, because now you have this inflation problem. You have people that are worried about the strength of the dollar. That's what inflation is. And then the government's ability to pay for this debt also becomes threatened when they're not generating enough tax dollars, which is why some people have proposed we can print money to pay down our interest. And you can start to see why that would be such a big problem. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.